Welcome to Section 7 of the ASC 405 Liabilities Training Series. This final section brings everything together: how liabilities appear on the face of the financial statements, what the footnotes must say, where US GAAP and IFRS diverge, and what your team needs to do at every period end to make sure nothing falls through the cracks. By the end of this section, you will be able to place any liability correctly on the balance sheet, current or non-current. You will know exactly when offsetting is and is not allowed. You will understand what the footnotes must say for each liability type. You will recognize where US GAAP and IFRS produce different outcomes for the same transaction. And you will know how to close out a period cleanly using the controls framework for your team. Here is where readers of your financial statements look first to assess short-term liquidity. Current liabilities are obligations expected to be settled within 12 months of the balance sheet date. That means accounts payable, accruals for wages and utilities, the slice of long-term debt that comes due next year, deferred revenue you expect to earn in the near term, taxes owed, and any short-term credit lines. Each of these tells a different story about cash pressure. Getting the classification right is not just a technical requirement. It directly affects working capital ratios that lenders and analysts use to assess your financial health. Non-current liabilities sit below the current section and represent obligations settling beyond 12 months. Long-term debt, multi-year lease liabilities, deferred revenue tied to performance obligations further in the future, AROs for facilities you will decommission years from now, and deferred tax liabilities from temporary differences. The split between current and non-current is not just formatting. It changes how investors, lenders, and analysts interpret your capital structure and debt service capacity. Any item that crosses the 12-month line must be reclassified. Most people assume that if you owe a vendor and they owe you, you can just show the net amount. That is wrong under US GAAP. You cannot offset a liability against an asset unless two conditions are both met. First, you have a legally enforceable right of set-off, meaning a contract or law permits it. And second, you actually intend to settle on a net basis or settle both obligations at the same time. If either condition is missing, you gross up. Presenting a net liability when you do not meet both tests is one of the most common balance sheet errors auditors catch at period end. Liabilities affect three financial statements, not just one. On the income statement, interest expense is a non-operating cost. It sits below operating income. Any gain or loss from extinguishing debt gets its own line in non-operating income and expense. On the cash flow statement, the logic splits based on type. Changes in operating liabilities like accounts payable, accruals, and deferred revenue flow through working capital adjustments in operating activities. But borrowing new debt is a financing inflow, and repaying principal is a financing outflow. The operating versus financing split matters enormously for anyone reading your cash flow statement to understand how the business generates cash. The footnotes are where the full story of your liabilities gets told. For debt, you must disclose the description, outstanding balances, interest rates, maturity dates, collateral pledged, covenant requirements, whether you are in compliance, and a maturity schedule for the next 5 years. Many teams disclose the covenant terms but forget to address compliance. Auditors will specifically look for that. For lease liabilities, you lay out the undiscounted future payment schedule, the discount rate applied, and the carrying amount split between current and non-current. This level of detail is required under the applicable standards and forms the basis for a lot of the questions your auditors will ask. 4 more liability categories require specific footnote treatment. For deferred revenue, you show the opening balance, the closing balance, how much revenue came from the opening balance, and when you expect to recognize what remains. For contingent liabilities, you disclose the nature and the amount accrued, or the range if you have not accrued. And here is the part most people miss. Even if you cannot estimate the amount, you still describe the contingency. For asset retirement obligations, you provide a roll forward with accretion expense and estimate changes. For joint and several obligations, you disclose the total shared obligation, what your entity has recognized, and the portion attributable to co-obligors. Here is where the two frameworks diverge in ways that can materially change your financial statements. Under US GAAP, you only recognize a liability when a legal obligation exists, a contract, a statute, something enforceable in court. Under IFRS and IAS 37, constructive obligations must also be recognized. That means if your company has a pattern of paying discretionary bonuses or has publicly committed to a restructuring, you may have a liability under IFRS even without a legal contract. The covenant violation rule is equally different. US GAAP gives you more time. Debt stays non-current if you obtain a waiver before the financial statement issuance date. IFRS is more conservative. The waiver must exist on or before the balance sheet date itself. The measurement differences between US GAAP and IFRS for liabilities can produce meaningfully different balance sheet numbers from the same underlying facts. For joint and several obligations, US GAAP requires you to record the full obligation and then separately recognize an asset for what co-obligors will probably contribute. IFRS takes a different approach. You only record the share you actually expect to pay. On contingent liabilities, the gap is even sharper. US GAAP accrues the minimum of any range when no better estimate exists. IFRS uses the midpoint. That means IFRS provisions are typically higher. And for onerous contracts, where unavoidable costs exceed expected benefits, IFRS requires a provision. US GAAP has no general equivalent outside limited guidance in a SC 420. These are the errors that show up most often in practice, and each one has a clear prevention. If goods arrive before period end but the invoice has not, you still have a payable. Review your receiving reports. The current portion of long-term debt must be reclassified at every single period close, not once a year. Any cash received in advance for future services is a contract liability first, not revenue. In substance, defeasance does not extinguish a liability. You need a legal release from the creditor. And offsetting without both required conditions is one of the most common balance sheet presentation errors auditors flag. Add these to your mental checklist every time you close. If you know what auditors are going to test, you can prepare your work papers before they walk in. For accounts payable, they will check completeness by comparing your receiving reports near period end to your AP subledger, looking for anything received but not recorded. For accruals, they want a roll forward of each category with supporting calculations and a comparison to prior year amounts. For debt classification, they will ask for your maturity schedule, current portion calculation, covenant compliance certificates, and any waiver documentation. For deferred revenue, the roll forward must tie opening plus additions minus releases equals closing. For extinguishments, the payoff letter or creditor release is the key document, followed by your gain or loss calculation work paper. Controls only work when everyone knows their role. The team member performs the initial identification, classification, and recording work, and critically, flags any borderline or judgment-based conclusions to the team lead immediately, not at the end of the period. The team lead reviews all classifications, journal entries, and work papers, and also reviews disclosure drafts before they go forward. Any judgment-based conclusion, significant estimate, or disclosure requiring client communication gets escalated to the manager. The manager approves those conclusions, reviews and approves all final disclosures, communicates significant decisions to client management, and signs off before anything is issued. This escalation path is what keeps errors from becoming audit findings. Before you can close any period on liabilities, run through this checklist. For accounts payable and accruals, confirm that every goods receipt before period end has a matching payable. Reconcile the AP subledger to the general ledger. Accrue for all incurred but uninvoiced obligations, and use reversing journal entries to prevent double counting when invoices arrive. For debt, update your maturity schedule, reclassify the current portion, review every covenant, and confirm waiver status on any violation. For deferred revenue, review all advance payments, apply the current and non-current split, and document the performance obligation timeline. Finally, confirm no assets and liabilities are netted without a legal right, and verify all required disclosures are drafted and reviewed before issuance. Let us land the key points from this section. The current versus non-current classification is not just formatting. It shapes how every lender, analyst, and investor reads your balance sheet. Offsetting is allowed only when you have both a legally enforceable right and the actual intent to settle net. One condition is not enough. Under IFRS, constructive obligations, midpoint measurement of contingencies, and onerous contract provisions mean the balance sheet often carries more liabilities than under US GAAP. Your footnotes must tell the full story. Even contingencies you cannot estimate must be described. And disciplined team controls with clear escalation at team member, team lead, and manager levels are what prevent errors from becoming findings. Thank you for completing this section on presentation, disclosures, IFRS comparison, and controls. Thank you for watching. Subscribe for more training from PNJ Group.